If someone told you the stock market has delivered roughly 14% a year for the last 3 decades, would you expect to make about 14% most years? Most people would. And that one assumption quietly wrecks more investment plans than any bad stock pick ever does. Here's what people picture when they hear 14% average return, a steady climb. Year 1, up 14%. Year 2, up 14%. Like a fixed deposit, just with a better rate. It seems reasonable. An average is supposed to represent what's typical, right? But that's not how markets actually deliver their returns. The average is real. The steadiness is not. And when investors find that out the hard way, usually 2 or 3 quiet years into their investment, it's often the exact moment they decide to quit. Let's break down what's actually hiding inside that long-term average. Because there are really 4 separate ideas here, and each one changes how you should think about your own portfolio. First, an average return is not an annual return. It's a summary of very unequal years. When you hear that equities have compounded at around 14% a year over a long stretch, this is an illustrative, historical figure, and not a promise of future performance. That number is a smooth result. It's built by averaging together a handful of exceptional years, a larger number of ordinary years, and some genuinely bad ones. As an illustrative example from historical, backtested data, individual year returns over multi-decade periods have ranged from roughly -78% in the worst year to over 70% plus in the best single year, with most years actually landing in a modest single-digit to low double-digit range. The 14% isn't what happened most years. It's what you get when you divide the total growth by the number of years and pretend the path was smooth. It wasn't. Second, you cannot know in advance which year will be the outlier. This is the part that trips people up even after they understand point 1 intellectually. Knowing that a market delivers occasional bumper years doesn't help you if you don't know when they'll show up. Nobody enters a year knowing this is the one that will do 60 to 70% and carry the decade's average. If that were predictable, everyone would simply invest right before the good year and sit out the rest. In reality, the strong years arrive unannounced, often right after the periods that felt most discouraging, which is the opposite of when most investors are inclined to add money. Third, this uncertainty directly shapes investor behavior, and not for the better. Here's the practical consequence. An investor commits to staying invested for the long term, a decision that sounds easy in the abstract. Then 2 or 3 years pass where returns are flat, or single-digit, or mildly negative. Nothing dramatic has gone wrong. The market is simply doing what markets normally do in an ordinary stretch. But it doesn't feel ordinary to the person living through it. It feels like the plan isn't working. So they exit, often right before conditions improve, because that's frequently how these cycles play out. This isn't a character flaw. It's a completely predictable response to being handed an average number without being told how unevenly it actually gets delivered. Fourth, if you can't fix the market's behavior, you can design around it. Since nobody can smooth out how the market itself delivers returns, the only lever left is how the portfolio is built and how expectations are set going in. 2 things help here. One is simply knowing, before you invest a rupee, that flat or single-digit stretches are a normal feature of long-term investing, not a signal something has broken. Historically, in any given multi-year period, the odds of landing a strong double-digit year versus a modest one have been closer to a coin flip than a guarantee. As an illustrative example, roughly half of past periods delivered double-digit annual returns and roughly half didn't, based on historical, backtested data. The other is deliberately holding a mix of assets that don't all go quite in the same years, so the overall portfolio's journey feels less like the market's raw jagged path and more like a manageable, if still imperfect climb. Neither of these changes what the market does. Both change how survivable it is to stay invested through it. Think of it like a long road trip where you know the average speed will work out to 60 km per hour by the time you arrive. That doesn't mean you're doing a steady 60 the whole way. You might crawl through traffic at 15 kilometers per hour for an hour, then hit open highway and do 100 for the next 2. Someone who expected a constant 60 the entire trip would think the car was broken every time they hit traffic, even though slow stretches were always part of getting to that average. Before you invest another rupee, ask yourself, am I expecting the market to deliver its average every single year? Or am I prepared for the average to show up as a few strong years carrying several flat or difficult ones? Your answer to that question will decide how you react the next time returns go quiet, and whether you're still invested when they pick back up. That's it for this one. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.